In this problem, we're going to be looking at the factoring of accounts receivable without recourse. The factoring accounts receivable is a method that allows companies to generate cash immediately and not wait for their customers to pay them in the normal course of collections. This is done to free up cash flow. In this problem, a company is going to transfer $100,000 of receivables to a bank. This transfer is without recourse, meaning that if any of this $100,000 is not collected, the bank cannot ask the company to reimburse them. Now, the way these agreements work vary, of course. These are contracts between two individual parties. In this particular case, the agreement says that right up front, the bank is going to pay 90% of the receivables. Sorry, that's a little technical issue. The bank is going to pay 90% up front. That's $90,000. And there's going to be a retainage or a holdback of 10%. The amount that the company will receive depends on how much is collected by the bank. So the company has to estimate the amount that will be collected for the remaining difference between the $100,000 and the $90,000 they got in cash, and of course that's $10,000. The company believes that they will collect $7,000 of that $10,000. The other $3,000 will go bad. In the bank will collect the additional amount above $90,000 and remit it back to the company less a fee of 1%. Okay, so this is a bit complex, so let's take it step by step. First, what is the company going to receive? The company is going to receive cash. How much cash are they going to receive? Well, they're going to receive 90% of the accounts receivable balance of $100,000. So they're going to receive $90,000 in cash. And what is the company going to give up? Well, they're going to give up their right to those accounts receivable. And so they're going to get $90,000 and they're going to give up $100,000. Well, let's ask ourselves, what is the company entitled to down the road? What do we anticipate receiving down the road? Since we can make a reasonable estimate of this amount, we can go ahead and accrue an asset. So what are we going to call this asset? Well, it's not an accounts receivable. It's not from the sale of merchandise. It's not cash yet. It's not revenue. Well, we're going to call this the finance receivable. This is what's coming from the factory. And how much do we anticipate getting? Well, we anticipate that we will receive $7,000 above the $90,000. Total collections will be $97,000 off of accounts receivable balance of $100,000. The $3,000 that is not collected will not be the company's responsibility. That's the risk that the bank is taking. So the company is going to receive their anticipated $7,000. However, they're going to have to pay a fee of 1% of the total amount factored, 1% of the $100,000. So in the future, we anticipate receiving from the bank an additional $6,000. Well, now we have debits of $9,600. We have a credit of $100,000. We're not anticipating giving up anything. We're not anticipating getting anything. So for this difference of $4,000, what are we going to call this? We can't call this a sales discount. We're not giving customers any type of break. This is not a discount on finance receivables because we will not collect it down the road. Obviously, since this is in the debit column, we cannot call it a gain. We can call it a loss on the sale of receivables, or we can call it interest expense. Since this transaction meets the GAAP criteria to be treated as a sale, it'd be improper to call this an interest expense. Expenses typically relate to funds that are borrowed. Here we are selling our accounts receivable. So the most appropriate account would be loss on the sale of receivable. And that is our journal entry.